Taxes might end up being your largest expense throughout retirement, but there are some valuable tax planning strategies that can save you tens of thousands of dollars throughout the rest of your life. So in this video, I'm going to explain what tax gain harvesting is, how it works, and I'm going to show you how a single tax filer can use this strategy to generate $63,000 of tax-free income in 2025. So what is tax gain harvesting? In its simplest form, it's the strategic selling of assets that have appreciated in taxable accounts to take advantage of lower tax rates. So you're trying to sell an asset or a holding in your brokerage account, which is a taxable account. You're trying to sell that after it's gone up in value, hopefully at a 0% tax rate, which is much less than the other long-term capital gain rates that are available. So let's talk about how this works in practice. Right here, you can see what the long-term capital gains tax brackets look like. And in 2025, there are three different brackets. There's a 0% bracket, a 15% bracket, and a 20% bracket. If you have less than $48,350 of taxable income, the amount that is under that threshold, that is going to be a 0% capital gain rate on your long-term gains. Anything above that, from $48,350 up to $533,000, any capital gains that fall in that amount, that's going to be a 15% long-term capital gain rate, which is most common for most people. And then anything above that, that would be a 20% capital gain rate. And what you can see by looking at this on screen, comparing the long-term capital gain brackets versus your normal income brackets, and we're going to focus on the single filers here, you can see that the long-term capital gain brackets are always going to be cheaper as it coincides with the normal income tax bracket. So the first $48,000 of a long-term capital gain, if you have anything that falls into that amount, that's going to be at the 0% tax rate compared to the 10 or 12% bracket for your normal income. Also, it keeps going further. So if you have anything above that, it's a 15% long-term capital gain rate on the portion above $48,000, but you can see again on the normal income tax side, it's 22% or 24%. So the long-term capital gain brackets, they're always going to be cheaper than whatever your other normal income would be at that same level. So that's a huge benefit here. So if you've got brokerage accounts, or if you don't and you want to start funding it so that you have this opportunity, it would be wise to do so, because I love the flexibility of a normal taxable brokerage account compared to an IRA, because you can use the money whenever you want before 59.5 without having to go through any different loopholes or jump through any hoops. And you can also perhaps create a Roth IRA out of it by planning out when you take money from it and how you structure the sales or the realizing of gains within the account. So let's talk about what needs to happen here to really make this possible for you. The first thing is that you have to have long-term gains for this to be possible. You can't do this strategy with a short-term gain. Now, as you can see here on screen, a short-term gain is whenever you hold it for less than 1 year. So if you own a stock and you've held it for 200 days and then it's gone up in value and you sell it after it's gone up in value, you don't get to have that long-term capital gain treatment, which we just went over. You're going to have a short-term capital gain treatment, which is the same as the normal income tax bracket. So in order to do tax gain harvesting, you have to have long-term capital gains, which means you hold that for longer than 1 year. The second thing to know here is this is the opposite of a well-known strategy called tax loss harvesting, where you try to intentionally sell something that's gone down in value to offset other gains. So for example, let's say you bought a stock for $100,000 and now it's worth $80,000 because it's lost value. You can sell that $20,000 at a loss, and you can use that $20,000 to offset any other capital gains that you might have in your portfolio. So if you sold a rental property that's gone up in value by $20,000 and you sell a stock that's gone down in value by $20,000, those two things will cancel themselves out to where you pay no tax on the gain over here because you have a loss to offset it. Now, additionally, if you don't have any gains to offset against those losses, you can use $3,000 per year as the maximum to offset against your normal income tax bracket. So tax loss harvesting has its advantages, but in my opinion, tax gain harvesting has a greater advantage because you get to realize a huge tax benefit in the year in which you do that particular strategy. So that's the difference there. We're kind of have two different things. We've got tax loss on one side and tax gain on the other. One thing that a lot of people get confused on here is, Jacob, what if I have $40,000 and then I go try to sell $40,000 of gains at a long-term capital gain rate in my brokerage account? My income is less than the $48,000 as a single filer. Does that mean that all $40,000 of that capital gain that I'm going to realize in my brokerage account, does that mean that that gets a 0% capital gain treatment because my other income is less than 48? And the answer is no, because we have to focus on something called income stacking. Okay, so what happens here is you have other income sources perhaps, and then you have maybe your capital gains that you're going to realize in your account. Well, those capital gains simply get added on top of your other income to make up your taxable income. Okay, so we're going to walk through this here in just a moment as we go through an example, but maybe a visual to help you understand this is, let's say say that you've got a $20,000 IRA distribution that you've taken out of your accounts. Well, that fills up this portion of your brackets here. Now, if you see that the $63,000 of total room at the 0% long-term capital gain bracket, what you can see is, hey, that's not $48,000. So Jacob, tell me how that is $63,000. What does that mean? Well, if we look at the standard deduction for the single filer in 2025, that is $15,000. So 15,000 plus 48,000 equals your 63K. So this is the total amount of money that you can have and still have a 0% capital gain rate on your capital gains that are long-term. So that's how we reached this number, just so you know. So we're using that $15,000 standard deduction here in this scenario. But in this situation, we take $20,000 out of this. So now we only have $43,000 left of room. So if you're still under the impression that you can realize as many gains as possible because this amount is less than $48,000, you'd be incorrect, because let's say we have $100,000 of capital gains that we just realized in a brokerage account. We also have this $20,000 of an IRA distribution. That total is $120,000. But what happens here is only $43,000 of that $100,000 that you just realized, only $43,000 is at 0%. The other, what is that, $57,000? That would be at 15%, because that's going to be above what the 0% capital gain brackets are. So that particular portion is going to fall into the 15% long-term capital gain bracket, which again is still cheaper than the normal income tax rate. But if you thought that you would get 0% on all 100,000 of gains, that's not accurate. So that's what I wanted to say about income stacking. And just one more example really fast is this might be a normal situation for anyone out there that's retired, is maybe you have an IRA distribution of this much, you got some taxable Social Security about $15,000, you also have a pension of $20,000, you still have $63,000 of total room here, which means you have $8,000 of room at the long-term capital gains that you can realize and still pay 0% taxes on this amount of money. So that's how income stacking works. If you realize more than $8,000 in this scenario of long-term capital gains, it would be above that $63,000 total amount that you could have. And then you would have, that would be at 15%. So that's the actual way that this works. You don't get to realize all of your gains, unlimited amount at 0%. If your other income is less than 48, all the gains have to flow on top of your other income. And then you get to figure out where those gains get taxed at. So that's something to know here, to pay attention to. I see that one messed up or kind of confused on a lot of the time. Now, here's a question for you, Jacob. Is there any potential wash sale issues here? So whenever you sell a loss, let's say you sell $10,000 worth of losses in your portfolio, and then you turn around immediately and go buy that same security before 30 days has passed, you are going to create a wash sale issue where you don't get to actually realize the loss and use that to your benefit on your taxes. You've got to wait at least 31 days before you can go buy a similar security without creating that wash sale issue. Now, one of the questions that comes up sometime is, Jacob, hey, can I sell something that has gained value or gone up in value and then realize that at a 0% capital gain rate? So that would be advantageous. And then immediately go buy that same security again because I don't need all the money I just created for myself. Can I go buy that back again without creating a wash sale rule? And the answer is yes. It's because you're not using losses this year. You're using the tax code to your advantage on the gains. What you can do is, if you need $40,000 of income this year to live on, and let's say you can sell $80,000 and $40,000 of that 80 would be subject to a long-term capital gain rate, meaning that's the portion that has actually gone up in value. You can sell all 80,000, okay, and you only need 40, which means you can take the other 40 that you're not going to use and essentially buy back the same security the very next day and not create a wash sale issue, because again, you're not taking losses, you're using gains and you're using the tax code to your advantage to create those gains at the 0% bracket. Okay, let's go through an example together to kind of make this make more sense here. So we're gonna look at single Susie, and I want to kind of maybe outline like what this could look like. It's hypothetical, so just take these principles and then start applying it to your situation. And let me know down in the comments if you want to see maybe some more of these based on your situation with different income amounts or different income sources. Just let me know in the comments. But today, we're going to assume that for her income, she's single and she's got no other income and she's retired. So no earned income, no IRA withdrawals yet, no Social Security is being turned on. She's not turning that on just yet, and she has no rental income or anything like that. So $0 in income. Now for her account type, she's got $600,000 in her IRA. She has nothing in Roth, and then she has $180,000 in her brokerage account. That's really where we're going to be operating in this. So let's look at this. She's got $180,000 in the account right now today. That's the current value, but her original investment was $90,000, which means $90,000 is actually the gains in the account. So that means 50% of the total value of the account is capital gains, and they're all long-term. She's held this for more than a year, so she qualifies for that. So let's kind of run through this together. Let's say we've got $63,000 of room. All right, she has no other income, so she doesn't have to subtract anything out of that. So she still has 63 of room. And if she wants to create $63,000 of capital gains and pay no income tax on that, what she can do is she can now multiply this by 2, because again, in her situation, 50% of her total account value is gains. The other 50% is the original investment. So what we can do is we can say that's $126,000 that she can realize, actually sell in her account out of her 180. So 126 of the account value is what she can sell and then pay no income tax on all of those gains, which would be $63,000. So now she has $126,000 she just created for herself. Of that, $63,000 was capital gains, but 0% is the tax being paid on it. So she probably could have a lot of money extra left over that she doesn't need. So what she can do is she can take the leftover, she can invest that back to her brokerage account, which is essentially resetting her cost basis and bringing that up to the current value, or she can simply hold that in cash and use that as income for years to come down the road. So what she's doing there, she's creating a lot of potential income for herself at a 0% capital gain bracket. So now let's add a different variable in here. Let's say that she has a pension of $40,000. All right. So she got a pension of $40,000. We're going to assume no other income, no IRA distributions or anything like that. But if we have $63,000 is kind of the total max before we jump into that 15% long-term capital gain bracket, what we can do now is we can say we're going to subtract out $40,000 of her pension amount. So that leaves $23,000 for her. So she can sell $23,000 of capital gains in her account. And then what that would do is if we multiply that by 2, again, if she has 50% of her total account is gains, that means $46,000 is what she can sell out of her, let's see here, out of her $180,000. So $46,000 is how much she can sell at a 0% capital gain bracket. So again, she can now have a total of $86,000 coming into her checking account this year from her pension, but also from the sale or realizing of these gains, and none of the capital gain portion is taxable. Now, if we really want to get down to this, we could say that $40,000 is her actual taxable income amount. If we subtract out $15,000 there, $25,000 is left over as her taxable income. Okay, which means the $15,000, that's her standard deduction that she would be using. So $25,000 is left over. This $23,000, that's not taxable to her at all. This is the only taxable portion of her total income of $86,000. $25,000 is the only taxable amount after we factor in that standard deduction. Run that through the single filer tax brackets, and that's what you come up with as her total tax payment. So tax gain harvesting is a huge benefit for people with a brokerage account that is appreciated in value, especially when you have lower income years such as single Susie in this example. So think about your situation. How does this apply to that? Are there ways that you can implement this? If so, leave a comment down below, but also share any other video ideas that you might want that could apply to your situation a little bit better. Thanks for tuning in. We'll see you next time.